The Florida dream is crashing hard for thousands of homeowners right now. In the past 12 months alone, home prices have plummeted by more than 19% in some of Florida's most sought-after markets, erasing hundreds of thousands of dollars in equity overnight. We're going to reveal exactly which 12 Florida cities are experiencing the steepest price declines heading into 2026, backed by the latest data from Florida Realtors, CoreLogic, Zillow, and Redfin. If you're thinking about buying or selling in these areas, this video could save you from making a devastating financial mistake. What we're witnessing across Florida isn't just a gentle market correction. It's a dramatic unwinding of pandemic-era price gains that sent home values soaring to levels that simply couldn't be sustained. Condo prices are now declining in 92% of Florida's housing markets, while single-family home prices are falling in 66% of the state's major metropolitan areas. That's not normal market fluctuation. That's a systematic correction happening right before our eyes. Before we dive into the data, make sure you hit that subscribe button and turn on notifications for housing intel. We cut through the noise and give you the real numbers you need to make smart real estate decisions. Now, let's break down exactly what's happening in Florida's housing market. Let me give you the numbers that should concern anyone holding Florida real estate right now. Florida home prices surged 51% between March 2020 and June 2022, compared to just 41% nationally. What goes up that fast can come down even faster, and that's exactly what we're witnessing as we head into 2026. The current median home price in Florida sits at $408,400, according to Redfin's October 2025 data. That's down 0.39% compared to last year. But that statewide average masks some truly dramatic declines happening in specific markets across the state. Here's what makes this situation different from a normal correction. Inventory is exploding. There are currently 209,069 homes for sale in Florida, up 4.1% year over year. That's the highest inventory level we've seen since before the COVID pandemic. And in some markets like Fort Lauderdale, we're seeing inventory levels not witnessed since the 2008 housing crash. Days on market are stretching longer. Properties are sitting for a median of 83 days in October 2025, up 13 days year over year. When homes sit longer, sellers get nervous, and that's when price cuts accelerate. The combination of elevated mortgage rates hovering around 7%, skyrocketing insurance premiums averaging $7,000 to $9,000 annually in high-risk coastal zones, and rising property taxes has fundamentally broken the affordability equation that made Florida attractive during the pandemic boom. Now, let's dive into the 12 markets where the collapse is most severe. Market number 1. Naples, Immokalee, Marco Island. Naples leads our crash list with a devastating 19.2% price drop in just 1 year, bringing the median home price down to $767,800. This isn't just any market. Naples has been synonymous with luxury Florida real estate for decades. Closed sales in Naples plummeted 15.3% year over year. Even at these reduced prices, buyers aren't rushing in. 1 in 3 sellers have already slashed their asking prices. With 7,998 homes currently listed, the inventory glut is only getting worse. The luxury segment that drove Naples's pandemic boom is now in full retreat. High-end buyers who were throwing money around in 2021 have disappeared, leaving sellers with properties overvalued by hundreds of thousands of dollars. Market number 2. Punta Gorda. Punta Gorda follows with a brutal 14.5% price decline, dropping median prices to $325,000. CoreLogic's market risk indicator shows Punta Gorda has a greater than 70% probability of experiencing further price declines over the next 12 months. Despite the massive price drops, closed sales actually increased 1.7% year over year. The market is finding a price point where buyers engage, but it's significantly lower than sellers expected. Punta Gorda leads all Florida markets in both condo price declines at 11.4% and single-family home declines at 7.3%. When both segments fall simultaneously, it signals broad-based weakness. Market number 3. The Villages. The Villages saw an 11.3% median price drop to $347,000. Despite this significant decline, closed sales surged 23.8% year over year. Retirees are finally finding affordability in a market that had priced them out. But anyone who bought in the Villages over the last 2 years is likely underwater. The Villages exploded during the pandemic as baby boomers relocated to Florida's tax-friendly environment. Prices surged beyond what retirees on fixed incomes could afford. Now we're seeing the correction. An 11% decline in 1 year has real financial consequences for people on fixed incomes who were counting on their property to fund retirement. Market number 4. Sebastian-Vero Beach. The Treasure Coast experienced a 10.2% price decline, with median prices falling to $386,190. This area was a major beneficiary of work-from-home migration during the pandemic. But as companies have called employees back to offices throughout 2024 and 2025, that demand has evaporated. The market is now dealing with excess inventory from speculative buyers who purchased assuming remote work was permanent. Those assumptions are proving costly. Market number 5. Northport Sarasota-Bradenton. This metro saw a 9.9% price drop, bringing median prices down to $475,000. Northport specifically shows an 8.9% decline in condo prices. This area represents the perfect storm. It experienced massive pandemic appreciation, has significant hurricane risk, and now faces skyrocketing insurance costs. Annual insurance premiums have quadrupled since 2020, reaching $8,000 to $9,000 per year in some neighborhoods. When you add property taxes reaching $6,000 to $8,000 annually, the total cost of ownership becomes prohibitive for many buyers. Market number 6. Cape Coral-Fort Myers. Cape Coral-Fort Myers rounds out our top 6 with a 9.6% decline, bringing median prices to $375,000. This Southwest Florida market was ground zero for Hurricane Ian damage, and recovery hasn't gone smoothly. The combination of storm damage, rising rebuilding costs, and reduced buyer interest created a perfect storm for price declines. Properties needing major repairs are flooding the market, driving down values for everyone. Insurance has become a nightmare. Many insurers pulled out entirely after Hurricane Ian's $30 billion damage toll. Homeowners who can find insurance pay premiums that have doubled or tripled. Market number 7. Tampa-St. Petersburg Clearwater. Tampa Bay saw a 1.3% price decline to $400,000. This seems modest, but analysts predict Tampa could see price drops up to 10% throughout 2026 as inventory builds and demand weakens. Tampa condo prices have already fallen 7.9% year over year. With mortgage rates remaining elevated, the single-family market is following the same trajectory. Tampa's strong job market provides some stability, but housing costs have outpaced local wage growth for too long. Tampa represents a market in transition, with trajectory clearly downward. Market number 8. Lakeland-Winter Haven. Lakeland-Winter Haven experienced a 2.5% price decline to to $325,000. While this seems small, CoreLogic identifies this area as having very high risk of experiencing significant declines in 2026. CoreLogic's models indicate Lakeland-Winter Haven could see price drops approaching 15% over the next 12 months. This would bring median prices down to approximately $276,000, erasing gains back to 2021 levels. Market number 9. Daytona, Ormond Beach. The Daytona Beach Metro fell 2.2% to $352,000. This market never experienced extreme appreciation like Southwest Florida, but it's still feeling pressure from reduced tourism demand. Daytona's economy relies heavily on tourism and seasonal visitors. As inflation has squeezed household budgets nationally, tourism spending has contracted, putting pressure on the service economy, supporting the housing market. Market number 10. Gainesville. Gainesville dropped 1.4% to $349,400, but CoreLogic identifies it as being at very high risk of experiencing price drops up to 15% in the coming year. University towns usually provide stability, but even Gainesville isn't immune to Florida's broader correction. Student housing has been overbuilt recently, putting downward pressure on rents, which affects investor appetite for single-family rentals. Market number 11. Palm Bay, Melbourne, Titusville. The Space Coast recorded a 1.2% decline with median prices at $365,500. Analysts classify this area as having very high risk for significant price declines in 2026. The aerospace industry provides economic stability, but housing costs have outpaced local wages for too long. Properties now take 72 days to sell on average, suggesting buyers are becoming more selective and price-conscious. Market number 12. Port St. Lucie. Port St. Lucie fell 1.2% with median prices at $420,000. This represents the broader Treasure Coast correction as remote work policies normalize. However, Port St. Lucie has factors working in its favor long-term. Investment analyses highlight rental yields of approximately 6.8% with low vacancy. The city attracts stable demographics of retirees and families, providing a price floor that some markets lack. Now let me tell you exactly why these crashes are happening and why they're far from over. The insurance crisis. Florida homeowners face skyrocketing insurance premiums due to severe weather events and insurance companies abandoning the state. Premiums have surged 4 times since 2020 in high-risk coastal zones. Many buyers now face annual costs of $7,000 to $9,000. In cities like Tampa Bay and Naples, monthly premiums alone can add $500 to $800. When your insurance costs more than many people's rent in other states, you've fundamentally broken the affordability equation. Mortgage rates are crushing demand. With mortgage rates hovering around 7%, buyers simply can't afford what they could 2 years ago. Closed sales for single-family homes in Florida declined by 3.6% from January 2024 to January 2025. The math is brutal. A $400,000 home at 3% interest costs $1,687 monthly. That same home at 7% costs $2,661 monthly. That's almost $1,000 more per month for the exact same house. Inventory is exploding. The monthly supply of inventory increased by 43.8% year over year. Florida had 224,921 homes for sale in April 2025, up 18.5% year over year. New listings were down in every month since May, while delistings surged 60% year over year in August. Sellers are giving up rather than accepting market prices, pulling homes off the market and hoping conditions improve. The migration reversal. The pandemic-era migration to Florida is over. Work-from-home buyers who drove the boom are either returning to their home states or have already bought. U-Haul pricing data shows the cost of one-way rentals out of Florida has increased, while rentals into Florida have become cheaper. Climate risk is finally being priced in. By 2026, buyers increasingly prioritize climate resilience. Hurricane Ian showed everyone what climate risk means in actual dollars. Buyers now demand detailed flood zone analysis and insurance cost estimates before making offers. Properties in high-risk zones sit for months. What this means for buyers. If you're a buyer, these 12 markets represent both opportunity and danger. Opportunity because prices are finally becoming more reasonable after years of pandemic insanity. Danger because falling knives can keep falling. And what seems like a deal today might look expensive 6 months from now. According to Zillow forecasts, 24 Florida markets could see home prices drop by early 2026. This correction has a long way to run. For buyers, the strategy should be patience and selectivity. Don't rush into purchases because you fear missing out. In a declining market, time is on your side. Sellers become more motivated, inventory builds, and you gain negotiating leverage. Focus on properties with manageable insurance costs in areas with lower climate risk. Look for homes with wind mitigation features, concrete construction, and modern roofing that qualify for insurance discounts. Run detailed cash flow analysis that includes realistic insurance and property tax projections, not outdated estimates from the seller. Consider waiting until late 2026 or early 2027 when the correction may have fully played out. Yes, you might miss the absolute bottom, but you'll avoid catching a falling knife and losing equity immediately after purchase. What this means for investors. For investors, the traditional buy-the-dip strategy might not work in Florida real estate right now. When you combine declining prices with rising insurance costs and climate risk, the cash flow math becomes very challenging very quickly. A property that produced positive cash flow at 2020 prices with $3,000 annual insurance might now be cash flow negative with $8,000 insurance, even if you paid 20% less for the property. That math doesn't work. Investors need to focus on markets with strong rental demand, stable employment bases, and manageable insurance costs. Jacksonville, Orlando, and Tampa may offer better risk-reward profiles than Naples, Cape Coral, or Punta Gorda for buy-and-hold strategies. Some investors may find opportunities in foreclosures and distressed sales if they emerge in 2026. But proceed with extreme caution and detailed due diligence on insurance availability and costs before closing any deal. What this means for sellers. If you're holding property in any of these 12 markets, you need a clear exit strategy. Waiting and hoping for a return to peak prices could mean years of stagnation while paying escalating insurance and carrying costs. If you need to sell, price aggressively from day one. The days of listing high and negotiating down are over. In a declining market with high inventory, overpriced homes sit for months while buyers focus on well-priced properties. Consider selling now rather than waiting for spring 2026. Many sellers are holding through winter hoping for better conditions in spring, which could create a wave of inventory that drives prices even lower. The bottom line is this. Some experts predict home values in certain Florida markets could drop by as much as 10% throughout 2026. With all the structural problems we've outlined, that forecast seems conservative rather than alarmist. The Florida real estate market isn't experiencing a gentle correction. It's undergoing a systematic repricing that could take years to fully play out. The fundamentals that drove the pandemic boom, low interest rates, remote work flexibility, and cheap insurance have all reversed. What remains is a state with high costs, significant climate risk, and prices that got ahead of economic fundamentals. Florida's long-term appeal hasn't disappeared. The state's population will likely continue growing, driven by retirees, no state income tax, and lifestyle appeal. But the easy money phase is definitely over. The next few years will separate smart, patient buyers who get genuine value from impatient buyers who overpay in a declining market. If you're holding property in any of these 12 markets, have a clear strategy. If you're thinking about buying, remember that catching falling knives is dangerous. Waiting for the bleeding to stop might mean missing some opportunities, but it also means avoiding significant equity losses in the near term. Make sure you're subscribed to Housing Intel for more real estate market analysis that cuts through the noise and gives you the data you need to make smart decisions. We're tracking these Florida markets closely throughout 2026, and we'll keep you updated as the situation evolves. What do you think about these market crashes? Are you seeing similar trends in your area? Drop your zip code in the comments below and let us know what you're experiencing on the ground. And if you found this analysis valuable, hit that like button and share this video with anyone thinking about buying or selling in Florida. The Florida real estate market in 2026 will test everyone's decision-making. Stay informed, stay patient, and make decisions based on data rather than emotion. We'll see you in the next video.